Okay, so hello, welcome to our Redline Hotels research presentation. My name is Ian David.
I'm Derek Faber.
I'm Kevin Lee. I'm Tate Steele.
So for our recommendation, we recommend a hold based on a calculated one-year target price of $10.16. This represents a 0.6% upside from the $10.10 price as of January 12th of this year. Our key catalysts for the recommendation are their shift to an asset-light business model, industry-leading rewards program, and good short-term economic prospects. Our key risks for this recommendation are their inability to maintain their growth rate and their increasing industry competition.
Redline Hotels has over 1,100 properties and 70,000 rooms across 48 states and 4 countries, making them the 10th largest franchisor in the United States. They have 9 different hotels across 3 different business segments: upscale, mid-scale, and economy. The Redline Hotel management team is primarily new, with 4 of the 6 executive members joining after CEO Greg Mount took charge in 2014. Greg Mount is a 30-year industry veteran and proven joint venture real estate expert. Prior to joining Redline Hotels, he was president of Richfield Hospitality, China.
So one of Redline's key strategies is their shift to this asset-light business model. They continue to shift towards this with the sale of 11 of their remaining 18 company-owned hotels. This asset-light strategy has led them to acquire the franchise rights to over 1,000 hotels, which we believe leads to greater reach, lower capital expenditures, and increased profit margins. They continue to look for new franchisees with their RevPAC segment, which offers the following software to provide a customized guest management suite that will help the franchisees measure results and increase bookings. Another part of their strategy is their Hello Rewards program. Their Hello Rewards program accounted for 35% of their direct bookings in 2016-2017. Rewards program members spend on average 67% more than first-time customers with Redline, and so we find it important for them to keep growing their segment. They've recently partnered with Expedia to do this, and in 2016, 49% of they've seen a 49% growth in membership and a 71% growth in 2017.
Many hotels across the industry are turning towards an asset-light strategy. As a result, these hotels are seeing higher year-over-year revenue growth compared to asset-right competitors. In addition to revenue growth, they are also less at risk to economic and seasonal cycles. As the graph shows above, there is an increasing use of online travel agency websites to book hotels. While these online travel agencies do provide a larger market for hotels, they pose a risk as they typically charge 15 to 20% of the room rate. We conducted a Porter 5 Forces analysis in order to identify the key threats to the hotel industry. We found that the threat of new entrants is high. With many hotels leaning towards an asset-light strategy, they're improving franchising incentives, making it more attractive to start a new hotel. The threat of substitutes is also high. With the increased use of vacation rental options, such as websites as Airbnb, they're making it more attractive to look towards options besides hotels. Bargaining power of suppliers we found is low. There are no major threats to the bargaining power of suppliers for hotels. The key threat there is the availability of skilled labor. And the bargaining power of buyers is high. With the addition of online travel agency websites, hotels, Airbnb, travelers have a large variety of options to choose from, and it makes it easy to compare options and values. And competitive rivalry is also high. There are numerous hotels in the industry, many of which have greater access to resources than Redline. The key indicators of competitive rivalry are brand name recognition, quality of service, and value.
So we've seen from a macroeconomic standpoint, as consumer sentiment has reached levels not seen since before the last recession. This is important for the hotel industry as we've seen relative consumer spending increase. We've also seen relative consumer spending increases in the hotel and motel segments as well, even in correspondence with a recent decline in air transportation spending. And this has led to key industry metrics being able to grow year over year on a year-over-year percentage basis. And so average daily rate and RevPAR have all seen an increase, even with occupancy rates remaining stable.
On revenue growth projection, we use different scenario analysis to project the revenue growth. As the company, pessimistic scenario capture the risk of inability to maintain growth. As based on our macroeconomic analysis, we project that the revenue growth will slow down in the upcoming years because the industry in the economic cycle and the capital requirements for Red Lion Hotel to maintain a steady growth is high. We also did ratio to compensation analysis to see the company's overview and project the ROE in the future. As the Red Lion hotels use different business model like to asset-light strategy, we project the ROE and profitability will begin to stabilize and be more stable in the future because the revenue increase. On valuation, we use the multiple enterprise value EBITDA multiples to project the target price. According to our industry analysis, the leading companies in the industry like Marriott and Hilton, are projected to leading the industry with enterprise value EBITDA above 13.5 because this company starts shifting to asset-light model. And so in the interest of conservatism, we predict Red Lion Hotel enterprise value and EBITDA range from 9 to 13. And we also combine that with scenario analysis. So our multiple price range from 722 to 1203.
We also did another valuation based on the discounted cash flows. So first finding the cost of equity, we used a risk-free rate of 2%, which is a 10-year treasury bond. And we used 3 different historical risk premiums for our valuation to come up with 3 different cost of equity. And so ultimately we came up with 3 different weighted average cost of capital, combining this with cost of debt of 7.29% and tax rate of 10%. So then using those 3 weighted average cost of capital, we could do a scenario analysis mixed with the 3 revenue growth scenarios as we mentioned before. And so we had a high of 13.99 and a low of 5.29. So our final valuation, we did a 70-30 mix, and we ultimately came to a target price of 10.16. So one of the key risks with our target price is the concentration of ownership. 5 different entities own about 41% of the company. So if any one of them decided to liquidate their shares, this could definitely pose a threat to the share price. Another key risk is, as we mentioned earlier, just the nature of the industry is very competitive. Red Lion has only about 71,000 rooms in their inventory, whereas larger companies have about, such as Marriott, have about 1.3 million almost. And then new and upcoming competitors like Airbnb have 4 million vacation rentals in their inventory, and they're continuing to grow. So the industry is only getting more. Another key risk is the risk of bankruptcy, represented by the Altman Z-score. Any Altman Z-score below 1.8 is a high risk of default. And as of the third quarter of 2017, they have 1.4, and they've been in that high risk area for the foreseeable past. So our recommendation is a hold with a target price of 10.16. We use 10 grams, 15% marginal safety for our recommendation. And the key reasons are ultimately the changing business model and the macroeconomic forecast.
Great. First question is, it seems as though many in the industry are moving to this asset-light structure. So as a result of increased competition, are some of the fees and royalties dropping as a result? I mean, it sounds like, a better business model, so therefore everybody wants to do it, therefore more competition, therefore, those on the other side of the deal can argue for a better rate, which could potentially hurt Red Lion. Have you seen, can you just touch on trends there?
Well, one thing is we did touch on the inability to maintain growth was kind of one of our worries in our valuation, because they did have the acquisition of Vantage Hotels last year, which is 1,000 hotels, and we do see it as a risk because maintaining 1,000 hotels added to the franchise per year does seem questionable.
And the capital requirement to continue those type of acquisitions.
Yeah. So you didn't necessarily see, collectively royalty rates, dropping. I mean, was that something that you just,
I don't think that's something that we
Okay.
saw.
Okay, second question, just looking at asset disposition, I think you mentioned 11 hotels. What's your estimated proceeds from those, and what's going to be the use of funds from the proceeds?
Well, part of the use of proceeds is really leveling out their balance sheet, getting rid of debt, and then also using that to fund for the growth of their franchise business.
Yeah, so they want to continue providing incentives to continue their growth. And that's, competing with other large brands like Marriott and, things like that. You have to really incentivize a lot of these, new franchisees with incentives. So
And any ballpark on proceeds?
For their remaining 7, they're actually looking at selling I think it's around 7 of the remaining hotels that they still have. They were, I think, ballparking 155 to 175.
Okay. Go ahead, Craig.
Can you talk to the franchise business itself and explain how, what they receive per hotel or per room?
What was that? Can you repeat your question?
The revenues that RL gets per franchisee?
I don't know that we have an exact number that they get per room, but they do it based off of they do it based off of a flat fee for some of their hotels.
8 of the 9 hotels are flat fee based.
Yeah. So,
And last month, they just released a franchisee website to promote that franchise segment. And it's about, they said about 3.5%, 3.5% of the revenue for franchising.
Okay. With respect to the top line revenue, you say somewhere in the 2 to 11%? That's a pretty wide spread on revenue growth. How do you come to that conclusion?
So we did our most likely scenario based at about 8, and we weighted our most likely at 8%. We weighted that at 60%, and then our most optimistic we did 11% for the next year. Pessimistic we did 4% for the next year. The weights are based off of largely the coming off of this last year. They had about a 15% growth rate, and that was with their huge acquisition. And we know that they want to continue that, but the capital gets about $40 million in order to make that type of growth. And so we don't think that they're going to be able to maintain that again this year. And so all of our growth rates were declining as the macroeconomic cycle kind of continues to decline. So we put a big weight on the 8% because we kind of, they're still going to continue growing, but it's not going to be anywhere near what they did though this last year.
Okay, so that 8% baseline growth is 100% organic?
Yes. Yeah.
Okay.
Hey guys, so on the most recent quarter, I noticed that their company-owned operating division did 18.6% operating margins versus their franchise division that only did 15.6% in operating margins. Why do you think they would be wanting to allocate resources to their lower margin business?
I think it, part of their switch to the franchise model allows them to really kind of have more stability in their kind of revenue and their operating margins. What we found is that they have a very kind of up and down quarters. I think quarter 2 is one of their kind of better quarters, and then in the winter, they have some of their worst quarters. So I think the move to a franchise model allows them to have kind of more stable revenues going forward. So I think that's kind of the main shift towards this strategy.
Okay, and then in terms of your guys, I'm not familiar with this ratio, but the Altman Z-score, do you think that that's really a relevant metric given they're going to raise 165 to 180 million in proceeds over the next 12 to 18 months?
I mean, I think it takes into account it takes into account what they're at currently, and it evaluates their current levels, and they may or may not be successful in doing what raise capital. So it's still, I think it's still relevant.
Yeah, I think that's a good point.
Yeah.
And they may not be able to sell themselves. Rich, you want
Yeah, just your scenario analysis, I thought that was interesting as it relates to revenue growth, but did you attach to it or do any P&Ls with profitability, operating profitability, or net profitability associated with each of those years and that revenue range?
Are you referring to like our ratio kind of decomposition with?
Well, you had a scenario analysis on revenue, optimistic. I think you had a base case and a pessimistic. Did you do any kind of sensitivity analysis for operating income or net income under those different assumptions?
Yeah, the most of our analysis was based off of the most likely case scenario. But when we did like the multiples and discounted cash flow, that was all we did. All three of those in our pro forma, and so we got our valuation based off of all three case scenarios of revenue growth. So and that's where we came up with our different highs and lows.
So going back to my question earlier, organic growth, you guys should know that term. That means they're growing within their own current business model without acquisition. Okay, so let's talk about revenue again. Is that revenue all organic, and is it all just based on RevPAR growth or new rooms somehow coming into the program?
A huge part of their strategy is providing incentives. We don't think that they're going to be making huge acquisitions in the upcoming future, just because I think that they want to see how their acquisition plays out, and so they're going to focus more so on providing incentives and acquiring franchisees, individual franchisees or whatever it is, without making huge acquisitions. So, and then what was the second part of your question?
Well, you kind of answered it.
Yeah.
Right.
Okay.
And also, I think that they're going to be more of an organic growth now that they have a broader base of hotels to go off of. They're really focusing on what we touched on, the three distinct segments: the upscale, mid-scale, and lower scale. And I think they're really going to focus on, with their franchise easy, making it easy to come in, and they'll present to you what area you're going to be. If you want a hotel RL, they'll have a specific location only in downtown areas. I think they're going to focus on organic growth through their already, the 9 brands of hotels.
I got one more. You mentioned that you have a 70-30 mix in your valuation analysis. Why did you 70% discounted cash flow, 30% valuation? Is that right?
Yep.
Why did you pick a 70-30?
So we did. We weighted it more so on the discounted cash flows because we had a hard time finding a comparable group of competitors for the multiples. Competitors such as we use leading competitors such as Marriott and Hilton are supposed to lead at about 13.5. And so Red Lion doesn't quite have that high of a multiple, and so we went something less than that. But we felt more confident in our ability to use this kind of cash flows because they're so much larger than Red Lion, and so we want to rely more heavily on just have cash flows.
Did you guys look at all at their NOLs and kind of their tax situation, given there's so many changes happening in tax policy going forward?
Yeah, it was really hard to pick a tax rate just because of their history is.
That's time.
Okay.
Good job, you guys.
Thank you, guys.
Thank you very much.